Hello, everyone. I'm Professor Zhong from Department of Information and Finance Management. Welcome you to join my class. In today's class, I will give you a brief introduction on financial markets. Here is our class learning goals. Our class learning goal will include, first, after you learn this class, you have be able to differentiate between primary and the secondary markets. You have to distinguish what the main difference between primary and the secondary markets. Second, after you learn this class, you should be able to differentiate between money markets and the capital markets. What main difference between two markets is very important. You have to get a point, understand the main difference between two markets. Next, after you learn this class, you should be able to understand the concept of forex market. Forex market, in other words, we call foreign exchange markets. And finally, after you learn this course, you should be able to recognize that markets are become increasing global. In other words, the final part, I will give you an overview on the trend of the financial markets, why the markets are become increasingly global. Now, in this slide, we have to figure out, let's understand why study financial markets and the institutions. As we know, the financial markets and the financial institutions are primary channels through which capital is allocated in our society. So the financial markets play a very important role. We can match lenders and the borrowers. We can provide the funds flow in the financial markets. So investment and the financing decisions require managers and the individual investors to understand the flow of funds throughout the economy. So if you want to understand how funds are outflow or inflow, it's very important. You have to understand the main functions of financial markets. In addition, managers and the individuals must also understand the operation and the structure of domestic and the international financial markets. So for company managers or for individuals or individual householders, they want to raise money, they want to borrow money or lend money, they want to earn the interest, they want to make a loan. They have to figure out how financial markets works. So it's very important. All the participants, they have to understand the financial markets structure and how financial markets works. And here I give you a clear definition on financial markets. Financial markets are structures through which funds flow. So in the financial markets, I will show you a picture later or the diagram later. You will understand how funds flow into or funds flow outflow or inflow from some bodies to the other bodies or the other institutions to another institutions. It's very important for us to figure out, to understand which funds flow. And here I also give you the second definition of financial markets. Financial markets can be distinguished along two major dimensions. The first dimension, we can distinguish or break financial market into parts. The first part we call primary markets. The second part we call secondary markets. The other dimension, we also can break down financial markets into type of markets. The first one we call money markets. The other one we call capital markets. Now, in this slide, here I want to show you the main difference between primary and the secondary markets. what are primary markets? Here I give you a clear definition. Primary markets are markets in which the users of funds, such as corporations, are raising funds through new issues of financial instruments, such as stocks and bonds. In other words, how to define the primary markets is very easy. For the corporations, they want to raise funds or raise money from the financial market. They have to issue the financial instruments. The financial instruments, the most popular financial instrument they will issue to the financial markets is stocks or corporate stocks or corporate shares or corporate bonds, right? So through the markets, if the first time for corporation, the first time to issue the financial instruments through the markets to sell to the investors. So the markets we call primary markets. In other words, if for corporations, they are first time to issue the financial institutions such as stocks and bonds to investors, the markets we call primary markets. Okay, so primary markets include issues of equity by firms initially going public. The process we call IPO, IPOs. IPOs stands for initial public offerings. It's a very important step for company. If the company want to raise funds, raise money from the financial markets, it's the first time they issue the financial instruments to investors. If they issue the equity on financial markets, the first time they issue the equity, the process we call IPOs. It's a very important concept for you to understand, to memorize the keywords on primary markets. And relative to primary markets, here we have secondary markets. How to define the secondary markets? When after the financial institutions such as bonds or stocks, they issued on the financial markets. After the investor hold the financial markets, financial stocks or bonds, the second they sell to other investors. That means the markets that trade financial instruments once they are issued, the markets we call secondary markets. In other words, you can here I want to simplify the definition of the secondary markets. Once the financial instrument are issued in the financial market, and after the process, after the IPO, they sell their stocks or bonds through the market to the other investors. The markets we call liquid market or secondary market. And relative to secondary market, the prime market we can call issue markets. The first financial instrument or stocks or bonds they first time issue through the financial markets. The financial market we call primary markets. On the other hand, if after the securities or financial instruments they are issued, and the investor want to sell their own financial securities to other investors, the markets we call secondary market. In other words, we can call liquid market. And here I want to show you the flow chart to illustrate the main differences between primary and the secondary market. So here I show you the transfer of funds through the timeline. As you can see, on the top flow chart, I show you the primary markets, how primary markets works. So as you can see, here we have two sectors. The first one is for corporations. They want to issue the financial securities, right? Such as bonds or stocks. And how they can raise funds from the investors. So they can issue bonds or stocks, and through the investment bank. Investment bank, they will underwriting the corporations, right? And they will help the corporations issue the stocks or bonds to investors, right? In order to raise funds from the investors. So as you can see from the flow chart, you will see here we have two colors of arrows. The black arrow represent how the financial securities flow, right? So as you can see, the users of funds, the corporations issue the stocks or bonds, and through the underwriting with the investment bank, they can sell the stocks or bonds to investors, right? So on the flow chart on the right corner, here we have the investors. Investors, when they buy the stocks or bonds from the investment bank, they will provide the funds. So the red arrow represent the funds flow on funds, right? Funds flow from the investors to corporations, right? So here I show you how primary markets works. The most important part is the investment bank will play the role on underwriting on the financial securities. And on the top flow chart, here I show you how the secondary markets works, right? But very different from the primary markets. Here we have no investment banks, right? Once the security issued on the financial market, the investors who hold the securities, such as bonds and stocks, they want to raise funds from financial markets. They can sell their own bonds and stocks through the financial markets, sell to the other economic agent or the other investors, right? So here I show you the financial instruments flow is the black arrow. Black arrow, the direction on black arrow represent the financial instruments flow, and the red arrow represent funds flow, right? So the funds flow will from the other economic agent to the investor who hold the bonds and the stocks, right? So I show you very difference from the primary market, how the secondary market works. And the next slide, I would like to show you the main differences between the primary market and the second market in more detail. So how a primary market, here I raise a question for you. How were primary markets affected by financial crisis, right? If we face the financial crisis, as we know, the financial crisis will cause the value of stocks decreases a lot, right? So for corporations, they want to raise funds from the financial markets. If they face the financial crisis, they will know if they issue the bonds or stocks to investors, they will raise less funds than before, right? Especially during the financial crisis. So the financial crisis will cause the value of the primary market transactions decrease a lot, and will discourage the corporations or firms. They will lack of motivation to issue the new financial institutions, such as bonds and stocks, right? And here I show you more details on secondary markets. As we know, the secondary markets, in other words, is liquid market. They provide the environment, help the securities transaction from the one investor to the other investor, right? So secondary markets, actually they offer the following functions. The first one, liquidity, right? In other words, you can say the ability to turn an asset into the cash quickly as its fair market value, right? So it's very important. If we hold the securities such as bonds and funds, if we have a very well functioning secondary market, it's very helpful for us to raise funds by selling our own securities. It's very important. The second feature or the second function the second market will offer is information, right? According to the transaction in the second markets, the market value or the real stock price will represent information. Information about the prices of the value of investments. So if we can correct the information and we monitor how the price changes or the value changes, we will understand more information behind the stocks, behind the corporation. So secondary markets, the transaction information will provide us opportunity, make decision. We have to sell or buy the stocks or bonds from other investors, right? It's very important. And the last one is trading. Because secondary markets provide the liquidity. Liquidity is very important for us, right? Well-functioning secondary markets will help the security markets works very well. So we have the last function of the secondary markets is the transaction fee or transaction cost must be very low. The lower the transaction cost, the higher transaction value on securities, right? So the trading with a low transaction cost is also the last feature on secondary markets. And in this session, I would like to help you to distinguish money markets and the capital markets. Here, in this slide, I will show you the money markets versus capital markets. What the main difference between two markets? Let's define money markets first. Money markets trade debt securities or instruments with maturities of 1 year or less, right? If the corporation or government they want to issue the securities to investors to raise fund for a short term or short run. The short run or short term usually we will call the maturity date will less than 1 year, right? So they can issue the securities through the money market. The market we call the money markets. Most U.S. money market are over-the-counter markets, OTC. OTC means there is no real physical prices we can sell or buy securities through the markets. And compared to the money markets, here we have capital markets. Capital markets trade debt or bonds and equity or stocks instruments with maturities of more than 1 year. If the maturity date or the life of security will greater than 1 year, maybe 3 years, 5 years, or a longer time, the securities are transaction or are traded through the markets. The markets we call capital markets. Okay, so capital markets and the main difference between money market and capital markets are the life of the securities or the maturity date of securities. If the maturity date of securities is less than 1 year, or the life of securities is less than 1 year, the security are traded on the financial markets. The financial market we call money markets. On the other hand, if the life of the securities will last more than 1 year, and these securities are traded on financial markets, the financial markets we will call capital markets. So capital markets trade debt or equity instruments with maturities of more than 1 year. Okay, so here I show you the timeline to distinguish what markets belong to money markets, or what kind of securities belong to the money market securities, what kind of securities belong to the capital market securities. So the timeline is very clear. So the main difference are the life of securities. The life of securities is less than 1 year. The security are traded on money markets. Otherwise, if the life of securities more than 1 year, okay, so the securities are traded on capital markets. So capital market securities will include notes and bonds and stocks or equities, right? So it depends on maturity date. So maturity date is less than 1 year. The securities we call money market securities. Okay, and if securities, life security more than 1 year, maybe from 1 year to 30 years, less than 30 years, such as notes and bonds. So these securities we call capital market securities. Even for stocks, as we know, the stock is infinite life of securities, right? So the stocks is more than 30 years. Or no, if you hold stocks, as we know, there is no specified maturities, right? So here the timeline is very clear for us to distinguish what kind of securities belong to the money market security, what kind of securities belong to the capital market securities. And here I give you the 4 pie charts to show you how the money market instruments outstanding from 1990 to 2019. Okay, so 1990, as you can see, we have different colors, outstanding percentage shares on different timeline, right? As we know, as you can see, the biggest percentage, outstanding percentage or share is the commercial paper, right? 27%. 27% in 1990, the commercial paper transaction will account the higher percentage of the pie chart, right? And the next is the negotiated CD, certificate deposits. And next it will be the third, the biggest part is U.S. Treasury bills, right? In 1990. In 2000, as you can see, the commercial papers increased from 27% to 35.6%, increases significantly. And while the white color U.S. Treasury bills decreases from 25.7% to 14.4%. And while the NCD, negotiable certificate deposits, also face a little bit slight from 26.5% to 23.3%. Okay, and the other parts a little bit increase. And then from 2000 to 2010, let's take a look at the main difference from 2000 to 2010. 10 years later, as you can see, the white part on the pie chart, as you can see, is the U.S. Treasury bills increases a lot from 14.4% to 28.6%, increases a lot, right? And while the negotiated certificate deposits also increase from 23.3% to 29.1%, from 2000 to 2010. And then 10 years later, or 9 years later, from 2010 to 2019, as you can see, the federal funds and the repurchase agreement, the percentage outstanding increases a lot, from 25.6% to 46%. And while the U.S. Treasury bills decreases a lot from 28.6, or a little bit decreases from 28.6% to 28.3%. Okay, so and negotiate certificate deposit decreases a lot from 29.1% to 13.5%. So here I show you in past 20 years how the money market instrument outstanding changes. And here I also show you the other 4 pie charts to show you capital market instrument outstanding. So as you can see, the capital market, the outstanding, the most biggest increased part is the corporation stocks. Corporation stocks increases from 1990 to 2000 and 2010 and 2019. Increased a lot from 23.6% increases to the 43 or around 43%, right? And the other percentage outstanding, capital market instrument outstanding percentage, you can refer to the pie chart. I will show you the biggest change. The most important is the corporation stocks, right? And in this session, I would like to show you the foreign exchange markets. Foreign exchange markets, as we know, in the foreign exchange markets, we can engage in the transaction for different currencies. We can engage in the currency exchanges. We can exchange the currency, domestic currency to foreign currency, or foreign currency exchange to the domestic currency. So the foreign exchange market provides a market we can engage in the currency exchange in the financial markets. But we also face the foreign exchange risk. Foreign exchange risk is the sensitivity of the value of cash flow on foreign investments to change in the foreign currency prices in terms of dollar, right? So in the U.S. foreign exchange markets, for American investors, they can buy foreign currency assets and or sell their domestic currency assets for their different purposes, right? In order to gain the profit or hedge the currency risk, because the exchange rate fluctuates a lot between 2 different currencies, right? So how to hedge the currency risk, how to cover currency risk is a very important issue. Or even for some participants, they want to gain the profit. To gain the profit from the forex market, they have their own strategy to engage in the currency exchange in the forex market, right? It's a very important part for us to learn how to avoid currency risk, hedge a currency risk from the foreign exchange markets. So US dollar in the foreign exchange market, US dollar is the main currency relative to other currencies. Other foreign currencies for Americans, such as euros, Japanese yen, or Canadian dollar, or Swiss franc, even renminbi, right? For Americans, they can buy or sell different foreign currency assets through the foreign exchange markets. And the US dollar received on a foreign investment depends on the exchange rate between the US dollar and the foreign currency, when the no dollar cash flow is converted to the US dollars. So the foreign exchange market provide the price to match the different participants. They can engage in currency change on the financial markets. And the last part, I want to clarify the globalization of financial markets and institutions. As we know, U.S. markets, especially why we focus on the U.S. financial markets, are the world's largest financial markets. But international markets have seen rapid growth in recent years as a result of various factors. So, excluding U.S. financial markets, other financial markets located in the world also increases, also rapid growth very quickly. So I show you the main reasons. The first one is the pool. The pool of savings in the financial countries has increased, right? So the first reason caused the international markets rapid growth in recent years. And the second one is the international investors have turned to the U.S. and other markets to expand their investment opportunities. More and more investment opportunity on other countries, right? Not only in the U.S., but also in the other countries, especially in the Asia countries or Eurozone countries, right? And the next one is the information on foreign investments, and the markets is now more accessible and through, right? So for the more and more foreign investors, they engage in the buy or sell different financial securities through the globalization financial markets. And they will provide, the globalization financial market provide more information for the investors. And the next one is some U.S. Financial institutions offer their customers opportunities to invest in the foreign securities and the emerging markets at a relatively low transaction cost. So the reason is also very important. For U.S. financial institutions or U.S. Investors, actually more and more U.S. participants, investors, financial institutions, they offer their customer to invest the money on foreign securities in the global financial markets. That's why the international markets have seen rapid growth in recent years. And the other reasons also include the euro relative to U.S. dollar, the second biggest important main currency, or we call major currency is euro, right? The euro is having a notable impact on the global financial system, right? Such as the support value of euro is by Eurozone country. More and more countries, they will use euro, or they will use euro to be the unit of account on major the financial assets. And the next reason is economic growth in Pacific Asian countries. China or other emerging countries has resulted in significant growth in their stock markets. And the next one is deregulation in many foreign countries has allowed international investors greater access and allow the deregulating countries to expand their investment base. So due to the 7 reasons caused the international markets have seen rapid growth in recent years. In this session, let's discuss the trading process in the stock markets. As we know, all transactions occurring on the New York Stock Exchange occurs at a specific price on the floor of the exchange. we call the trading post. And each stock is assigned a specific market maker, the specific market maker, so-called a specialist. Specialists often organize themselves as firms due to large amount of capital needed to serve the market. We call the market making function. So the trading practice is very important in the U.S. Stock markets. Here I show you 3 types of transactions can occur at a given post. Okay, the first one, the brokers trade on behalf of the customers at a market price. The market price, we will send the order, and brokers will help their customers to buy or sell stocks on the stock markets. So the order we call market order. Market order is the brokers help the customer to buy or sell the stocks at a market price. Okay, and the second one, limit orders are left with a specialist to be executed. And then the next, specialist transaction for their own account. So I show you the 3 types of transaction can occur at a given post. And this line, I show you the majorities, the trading practice, the majorities of orders sent to the brokers of 2 types. As I mentioned before, the first type we call market order, right? A market order is an order to transact at the best price available when the order reaches the post, right? So if they can set up the market value, if the brokers help their customer or investors to buy or sell the stocks or shares at the current price or market price, the order we call the market order, okay, to reach the post. And relative to market order here, we have the limit order, right? Limit order, why we will have a limit order? Because the users or investors, they're afraid they want to buy the stocks at a low price or sell the stocks at a higher price. So they will have set up the limit price. So a limit order is an order to transact as a specified prices and on the post. So it's very important. If you want to avoid to buy or sell the stock price at a higher price or the lower price, you can set up the limit order to help you to avoid buy the stock price at a higher price or sell the stocks at a lower price. And here I show you a table. The table is the US stock gainer on February 21st, 2020. So you can see many stocks, the value of the stock increases on February 21st. And in this section, I want to show you the stock markets in the US. Okay, the stock market in the US, I want to introduce the NASDAQ and the OTC markets. Securities are sold on one of the organized exchanges and trade over the counter. Over the counter, in other words, we can call the OTC, abbreviation, the name of the over the counter OTC. OTC market do not have a physical trading floor, as I mentioned before. Rather, the transactions are complete via the electronic markets. For the represented OTC market is NASDAQ. NASDAQ was the world's the first electronic stock markets. Primary dealers, a dealer market, where dealers are market makers who stand ready to buy or sell particular securities. So here I show you the several features on NASDAQ stock markets in the US. In contrast to the New York Stock Exchange I mentioned before, NASDAQ is negotiated market, and such as the quotes from several dealers are usually obtained before the transaction is made, right? It's a very different feature from the NYSE, New York Stock Exchange. And in the Nasdaq stock markets, there are small order execution system provide automatic order execution for individual traders with orders of less than or equal 100 shares. So I'll show you the three features on Nasdaq markets. Nasdaq markets, stock market are very different from the New York Stock Exchange markets. And securities are not sold one of organized exchange, are traded over the counter. And the OTC markets do not have a physical trading floor. Rather, transactions are complete via electronic markets. Here I show you. And why for corporations, why some corporations or enterprises, they will choose, they want to issue the stocks through the NYSE, New York Stock Exchange. But some companies they prefer to issue their stocks through the Nasdaq markets. What the main difference between two markets? What the main different motivation force the enterprises they would like to issue stocks on NYSE or Nasdaq markets? Here I show you the choice of marketing listing. Okay, what reasons will cause firms or enterprises will list their stocks, corporate stocks, through NYSE or Nasdaq markets? Okay, as we know, firms list with the NYSE Euronext must meet the listing requirements of exchange. Actually, the requirements are more strict relative to Nasdaq markets. I will show you later. The requirements are extensive. Okay, the reasons a NYSE listing is attractive to a firm. For enterprises, if they want to issue stock through the NYSE, on the NYSE, actually they have to meet lots of requirements, right? If they meet the requirements, they can qualify to issue stocks through the NYSE. Why they want to do that? Because I show you the three main reasons. The first one, improved marketability of firm stock. Because if the company, once the company issue their markets through the NYSE, sell their markets to investors. Actually, on the NYSE, there are more investors. They will engage in the NYSE relative to Nasdaq markets, right? They can improve the market abilities of firm stocks. And the second reason comes from publicity for the firm, right? If they can issue the markets through the NYSE, actually is well-known stock markets, most famous stock markets in the world, right? So it's a very good way to promote their stocks through the NYSE. So it's publicity for the firm. And the last reason, improved access of financial markets. If once the stocks issue on the NYSE, actually more and more investors, they can buy the shares or stocks through the NYSE, improve the access to the financial markets. And if the firms, enterprises that do not meet the requirements, if they do not meet the requirement, that means they will not qualify to issue stocks on NYSE. So the second best choice, they issue stocks through the Nasdaq markets, right? So their listing trade well on Nasdaq. More Nasdaq firms are smaller, of regional interest, or unable to meet the listing requirements of organized exchange. Over time, many Nasdaq firms apply for the NYSE listing. So for most of smaller companies, once they want to, firstly, they want to issue the stocks on NYSE, maybe they will not meet the requirements. So they will choose the second best stock markets, I mean the Nasdaq. They can issue their stocks on Nasdaq. Over time, if they meet requirements for NYSE, they will apply for NYSE listing. And here I show you the electronic communication networks and the online trading, how the practice works. Okay, major stock markets currently open at 9:30 a.m. Very like to the it's very different from the Taiwan. In Taiwan, stock markets currently open at 9 a.m. right? 9 a.m. But in the U.S. Is 9:30 a.m. And Eastern time, and close at 4 p.m. Eastern time. But in Taiwan, we open Taiwan's stock markets currently open at 9 a.m. and close at 1:30 at 1:30, earlier than the U.S. right? And the transaction time is shorter than the U.S. stock markets, right? And the extended hours trading. In Taiwan, we also have extended hour trading. Extended hour trading from 1:30 to 2 p.m. To 2 p.m. But for the U.S. stock markets, extending hours trading involves any securities transaction that occurs outside these regular trading hours. Most extended hours trading is processed through the computerized alternative trading system, we call ATSS, and also know the electronic communication network, ECNS, such as NYSE, Okta, or Internet. And ECNS are computer-sized systems that automatically match orders between buyers and sellers and serve as an alternative to the traditional markets, making and floor trading. So I show you the practice on the US the stock markets. And the final section, in this section, I would like to talk about the stock market index. A stock market index represents the composite value of a group of secondary market traded stocks. Okay, so it's very important for investors. They have to know the stock market indexes. The stock market indexes represent the composite value of a group of secondary market traded stocks. The most famous stock market indexes is Dow Jones. Dow Jones in the U.S. in the Dow Jones Industrial Average. Dow Jones Industrial Average, DJIA, is the most widely reported stock market index. Include the value of 3 large corporations selected by editor of Wall Street Journal. It's very important. So the most famous the U.S. stock market index is Dow Jones, right? Dow Jones. Dow Jones. How to calculate Dow Jones stock index? They will select the top 3 large corporations, right? To calculate their value relative to, maybe we will choose the best year as the current year to make a comparative the total value, the market traded, the group of secondary traded markets composite value, right? So Dow Jones indexes are the price weighted averages. And NYSE companies index include NYSE list common stocks. So NYSE is a very weighted index. Okay, the second one. So here we have Dow Jones. Dow Jones represent Dow Jones Industrial Average Index. Here we also have NYSE Composite Index, and the next one is Standard & Poor's S&P 500 Index. Standard & Poor's 500 Index consists of the stock of top 500 of the largest U.S. corporation listed on the NYSE and the Nasdaq. And the Nasdaq Composite Index consists the stocks traded through the Nasdaq markets that are industrials, banks, and the insurance companies. So here I show you the list of the stock market indexes in the U.S. stock market. And Wilshire 5000 Index is the broadcast stock market index and possibly the most accurate reflection of the overall stock markets, because they contains virtually every stock that meet 3 criteria. The first one, firm is headquartered in the U.S. The second one is stock is actively traded in the U.S. Best stock markets. Third, the stock's widely available price information, which rules out of the smaller OTC stocks from inclusion. And through the index, start with the 500 firms. Because of the firms' deslistings, privatizations, and acquisitions, it currently include only 3,618 stocks. Okay, it calculates based on the very weighted index. So here I show another stock index in the US. And who are participants in the US stock markets? Here I show you the market participants in this section. The holders of corporate stocks from 1994 to 2019, the householders are the single largest holders, account 38% in 2019. And the second part is the mutual fund. Mutual funds and the foreign investors also account 23.5% and 15.9% respectively. And the household indirectly invest in the corporate stock through the investments in mutual funds and the pension funds. They account approximately 74% in 2019. So I show you the 3 main parts, main holders of corporate stocks from 1994 to 2019, right? Householders and the mutual funds, foreign investors, and indirectly invest in mutual fund and pension fund. And let's talk about the U.S. stock ownership rates are high relative to income, but also vary by age, right? Here I show you the age groups who buy the stocks in the U.S., who hold the most percentage on holding U.S. stocks. Over average, 62% of the U.S. adults age 30 to 64 own stocks, and then compare with 31% the lowest age from 18 to 29, and 54% of the age 65 and the other. So the biggest part to hold the U.S. stocks is the U.S. adult. From the age group is from 30 to 64, right? And the other issues pertaining to the stock market, here I show you several important economic indicators. If you want to predict how stock markets performance, we have to refer to the economic indicators. Several important economic indicators changes represent future performance in the real economy. They will affect the stock price. Right? So stock market indexes might be used to forecast the future of economic activities. So there are very close relations between economic indicators and the stock market indexes. Okay, an increase in the stock market indexes today potentially signals the market expectation of the higher corporation dividends and the profits, in turn, higher economic growth. That means if we find out the stock market indexes increases a lot, maybe in past few weeks, that means in the future we can make prediction. The real economy performance will perform very well, and the corporate will get more profit, and they will share the dividend to shareholders, right? And increases the stock price, right? So finally, in turn, we will accompany with the higher economic growth, right? We can find out the positive relations between stock market indices and the economic indicators. And on the other hand, a decrease in the stock market indices potentially signals the market expectations lower corporate dividend and the profit, in turn, lower economic growth, right? And the stock price are the one of the 10 variables included in the index of the leading economic indicators. So the stock price, the stock market indices belong to the leading economic indicators. We can use the indicator to predict the economic growth rate. It's very important indicators. And here in this session, I would like to talk about the market efficiency. The market efficiency refers to the speed with which the financial securities. 这边可不可以重录？老师刚才提到这边停一下了。刚刚提到就是
再讲还是要休息？
再讲好了，来再讲。
可以直接讲。
可以直接讲嘛哈，OK， 刚才那个重录哈那一段，就是我老师这边讲完之后跳到这边哈。In this session, I would like to talk about the market efficiency. The market efficiency refers to the speed with which the financial securities prices reflect unexpected news. If the international event happens, the event will affect the real economic activities, even will cause the stock price to increase or to decrease. The stock price will reflect the information immediately. Okay, we call the market efficiency. If they reflect the information very quickly, that means the market is more efficient. Okay, so we can use this way to measure the market efficiency, right? So here I want to break down the market efficiency to 3 types. The first one is weak form market efficiency. Weak form market efficiency concludes the investors cannot make more profit and the fair return by using information based on the historical price movements. That means if the market efficiency, we call the weak form market efficiency, that means for all investors, they cannot use their past information or using the information based on historical price movement to make prediction to earn the profit from the stock markets, right? Because all information, past information, all information reflect the real value of the stocks, or the price reflect the price of stocks, right? No one can gain the profit or assets return by using by using the information based on historical price movement. Okay, we call the weak form market efficiency. But in the weak form market efficiency, at this situation, the investors also can gain the profit by using the internal information or private information, right? Or the event happened right now. They can use by using the latest news, latest event to make profit from the stock market, right? And the next one is the semi-strong form market efficiency. Semi-strong form market efficiency, that means the investors cannot make more than in the fair return by trading on public news release. If the stock market, financial market, stay in the weak form market efficiency, actually the investors can using the public news released or the private or internal news to make profit from the stock market or from the financial market, right? But if the market stay in the semi-strong form market efficiency, that means investors cannot make profit by using past information or information based on historical prices, even also public news releases, right? So when financial markets stay in a semi-strong form market efficiency, that means only way to make profit for investors, they only can use the internal news or private news to make profit. They cannot make profit by using past news or public news release. Okay, the last form of the market efficiency we call the strong form market efficiency. Strong form market efficiency that's the stock price fully reflect all information about the firm. Both public or private news will not affect the stock price. Or for investors, they cannot use any information to make profit from the stock market. All information reflect on the stock price, or the all stock price fully reflect all information, right? No one can gain the profit from on the financial markets. So let's think about how about Taiwan stock market. Actually, Taiwan stock market is very close to the weak form market efficiency, right? And how about, because if we know the latest news, public news release, we can use the news to gain little profit, right? But also we can use the private news to gain more profit, or internal news, right? Actually, it's illegal in all countries, right? By using the private news or internal news, actually is illegal. But we can use the information to gain the profit that represent the stock market are not efficiency. So it's an efficiency theory in the stock market. I show you 3 types of market efficiency. That's all we have for today's class. Thank you for your participation.